Right now, global industries are pushing forward under immense coordinated pressure to successfully transition to a green economy. Governments, investors, and consumers are all demanding immediate environmental action. Regulators are handing down strict requirements to meet that demand. Corporations are expected to adopt circular economy models, where materials are continuously reused rather than discarded, and completely rid their supply chains of carbon emissions. But that momentum is hitting a massive macroeconomic roadblock, a sudden and sustained environment of high global interest rates. At the exact same time, global economic growth has slowed down, leaving companies with less revenue and fewer cash reserves to draw from. These realities are on a collision course. The top-down pressure of environmental mandates drives straight into the bottom-up restriction of a tightening economy. This creates a severe trap for businesses, caught perfectly in the middle, squeezed between environmental compliance and basic financial survival. Doing what is required to protect the planet is directly at odds with what is required to keep a company financially viable. To see exactly why this trap exists, we have to look at the physical mechanics of decarbonizing a massive corporation. Transitioning to sustainable practices involves the physical destruction and replacement of existing infrastructure. These are not administrative policy changes, they are massive engineering overhauls. Sourcing new raw materials, redesigning global logistics networks, and building state-of-the-art facilities requires an immense amount of upfront capital, and the timeline is punishing. Companies must spend billions to build these new systems over a period of years before they generate a single dollar of return. The green transition operates under the banner of environmental policy, but on a ledger, it operates as a massive, front-loaded capital expenditure, which brings us to how corporations actually fund those upfront costs. Historically, companies finance infrastructure through borrowing, but with high global interest rates, the era of cheap money is gone. The baseline cost to hold a loan has multiplied. This compounding expensive debt actively eats away at a company's available cash, crushing their short-term profit margins. Executives face a dire math problem. Taking on the debt required to fulfill green mandates practically guarantees severe financial losses for the quarter. Economists have a specific name for this mathematical trap, where transition clashes directly with survival. They call it decarbonization friction. Until the underlying math improves, this friction forces corporate boards to prioritize immediate financial survival over their long-term sustainability goals. The global shift toward a green economy presents itself as a technological and political challenge. In reality, it is a strict accounting problem. Government willpower and intense public demand cannot simply bypass the physical reality of expensive capital. If this friction continues, the global transition risks stalling out. Crucial climate deadlines will be missed purely because corporations cannot afford the financing costs. Breaking this deadlock requires one of two conditions to be met. First, the global macroeconomic climate must cool down, bringing interest rates back down to manageable levels. Or second, new financial models and subsidies must be invented to carry the burden of these massive upfront costs. Until one of those two systemic shifts occurs, decarbonization friction will remain the ultimate bottleneck of the modern economy. Building a sustainable future is impossible until the global market acknowledges and fixes the prohibitive financial cost of the present.